Good. It's 11 o'clock, so we should get going. Thanks very much for tuning in again. I'll be talking to Katie Potts of Herald in a minute, but first we just had a bit of news to have a look at. So I've pulled out three things this week. Let's start with AVI Japan Opportunity, which, as you can see, has been performing reasonably well. And the discount's been quite tight, not as much on the premium as it used to be, but it's been issuing stock, which is good and growing. And small yield, but there we go. The interesting thing about this, I'm really pleased. It's now the best performing Japanese fund over the past year. And actually, if you look at the 5-year numbers, it's also on top there as well. And that strategy that it's pursuing is really working. And that's one of the reasons why the discount is tight, I think. And you can see that there are some other strategies here that are not really doing very well. But the reason we're talking about it, so when it launched in October 2018, it had sort of 4-year run, and then they said in October 2022, we will give you the chance to have a liquidity event to possibly take some money out of the fund if you want to. If the strategy isn't working, or if you don't like Japan anymore, then there's an opportunity to cash in. And then we'll do it every 2 years after that. And that was kind of built into prospectus. It's entirely at the director's discretion, and it can be 100% redemption or it can be a partial redemption. That was the way that was kind of worded. And this year, because we're the third event, one of these, they're going to be 100% exit opportunity at a 2% discount to NAV. This needs to be approved by shareholders. And whether you actually go for it or not, on the basis of, if you actually did want to sell for whatever reason, despite the amazing performance, there's a sort of real toss-up whether it makes sense or not, given that 2% is not very far off where the discount is now anyway, and obviously markets can move around, so you may as well sort of choose your time to exit if you want to do that. So I don't think it's going to be taken up very much this year. But what they've said is that they're going to now do this every year, and it's all part of this idea that's protecting shareholders from a widening discount. And they think that if they keep the discount narrow, it'll trade at premium more often than it does at the moment, and that will allow them to expand the trust. I'm not convinced of that, to be honest. And I'm also not convinced that an annual redemption opportunity makes sense for this strategy, because it's a long-term approach. It's in small cap stocks. I've talked about it. I'm putting together an article for Citywire. You can read more about it on that next week, I think. Gore Street Energy Storage, I just wanted to mention this. Obviously, it's one of these trusts where the discount is just gone mental. It's still getting wider and wider. The yield's 13%, which just seems incredible. I actually had somebody talk to me at the ARC showcase the other day, questioning whether that's sustainable or not. And you'd think that, given what's going on with the share price, it wouldn't be. But although the NAV has slipped, it's still above where it was issued at, and I think that's going to reverse and start going up again. What they've just done, and that was just announced today, is that the big battery project that they're building in the Californian energy market, CAISO, is going to be energized in December. We knew that already. But they've signed a contract, what they call a resource adequacy contract, which is a bit like the capacity market and we have it here in Britain. Basically, what's sort of enshrined in law is that if you are providing power, you've got to be able to prove that you can cover peak demand for that power plus a reserve margin. And so obviously, if you're running a renewable energy plant, you're going to need to lock in some kind of energy storage contract to go alongside it. So they're not actually going to a contractual arrangement with one of these generators. The counterparty is a Goldman Sachs subsidiary, which is like a sort of energy trading broker. I'm guessing they are standing in the middle and trying to make a market in these. But notice that obviously improves the creditworthiness of the whole thing. And it's decent contract. So it basically covers the entire output of or potential output of the storage project, and it runs for 12 years. And it's $14 million a year from next summer, which is 40% of what they're expecting to earn from this asset. So that's locked in. And it would mean that they could get some debt finance secured on the basis of that now, which would free up some cash for Gore Street, which they could then use to either buy back shares or invest in the portfolio, depending on what makes sense in terms of returns. So the killer for this is really that they are saying, and they wouldn't say this unless they meant it, that they are going to see a fourfold increase in their cash flows from what we had for the year ended 31st of March 2024. Obviously, that doesn't run for FY25. That's going to be from when this contract starts, but nevertheless, that's quite chunky. And the key is it supports the ability to pay that dividend. So that 13% yield may not be that fanciful at all. Actually, I'm quite confident that they will be able to keep doing that. So that ought to be a big tick in the box. It ought to help the discount narrow, but we'll have to wait and see whether people believe it or not. And then lastly, another trust that's on a big discount that I think shouldn't be is RIT Capital Partners. And you can see it's this familiar pattern where things sell off in the wake of interest rate rises, and that's all linked to the growth stock portfolio in the portfolio selling off. But the NAV hit to that was nowhere near as big as the share price hit. That share price has been static for a while now, and I think that discount ought to be closing because they are now talking more and more about getting exits from that portfolio, and we should start to see this come through. There may not be in this current quarter because we've got the US election that's disrupting things, but I can easily see that we get through to Q1 2025 and these things start happening fairly consistently. So I think that discount should be narrowing anyway. But the other thing that's been going on here is that it was kicked off some of the investment platforms, the trading platforms. In July 2023, as Fidelity did it, and it was all around this business with the cost disclosure rules and consumer duty. So optically, it looked as though the charges on this fund were very high because it is subcontracting part of the management to other managers, and it has to include all the fees in this. And in the kit, I think it said the fees were something like 3.8%, which is obviously nonsensical. But nevertheless, that put people off, and Fidelity felt that they had to say to customers, "You can't buy this," which I think was wrong. And I think we said that at the time. We thought it was wrong. But these cost disclosure rules are being sorted out now. They're still not, completely nailed down, but everything is moving in the right direction. So we've got the FCA saying a lot of sort of warm, fuzzy words, but they've got to put that down into something concrete. And we've got the government now legislating to bring a new consumer composite investments regime to replace MiFID and PRIPS. And that should mean, if everything keeps going the way it should is at the moment, that investment trusts will not be double counted anymore. We should get sort of a zero in the cost thing, which obviously doesn't mean that there are no costs. We all know there are costs. One of the things we're going to do, I think, today is to draw attention to what Aberdeen has been doing in just explaining how its costs work. They've done a big detailed statements based on what the campaigners sort of recommended people should do. They look really useful, and we hope they're going to be widely adopted. So people will know what the costs are, but we won't get this misleading information anymore. So the good news is that Fidelity's put RIT Capital back on the trading platform. There was apparently a share price reaction to that yesterday. Hopefully this is the start of that discount narrowing. So that's all good news. That's enough from me. Now let's bring in Katie. So, good morning, Katie. I'll just let you unmute yourself. While we do that, we'll show people the disclaimers. There we go. Good morning.
Good morning.
So, as usual, I'm going to let you do the talking for a bit. Just tell us a bit about Herald and Herald Investment Management, and then we'll have some questions. So if people have got questions, please put them into the chat box and we'll put them at the end. But over to you.
No, well, thank you very much, and thank you for your interest in listening to what I've got to say. We put this statement in our report accounts this year. The company is fortunate in having a mandate to invest in a sector that demonstrates growth and innovation continues at an extraordinary pace. I say that because obviously in the context of a gloomy world of tax rises and budget deficits, a lot of other sectors have probably got more headwinds. Can we go on to the next slide? By way of background, I was a sell-side analyst covering the tech sector, and chose to leave the end of '93 because I believe that in the UK, the large companies were rather uninteresting in the sense it was telcos and GC Marconi, but there were a raft of interesting small companies. And I was aware that it's difficult for professional investment managers and retail investors alike to invest in small companies because there's more stock-specific risk and not very much liquidity. So why not offer a collective vehicle that means people can get a reduced risk exposure to risky assets, because we have minimized the risk with diversification. And that was the case I made when I raised the fund in '94, and it hasn't changed. And we invest on a fundamental basis and have quite a labour-intensive team, because small companies with a global mandate means we're all quite busy. And increasingly, we have to travel because people don't come to London in the way they did in the past. But in context, I raised 65 million in '94 and 30 million 2 years later to globalize the fund, and haven't raised any money since. And on the next slide, a bit of a scoreboard. The median market cap is 217 million. By value, the top 30 stocks probably account for a third of the portfolio. But we do have a long tail, as we always have, because that's where we're helping younger companies to establish themselves. And although we only raised 95 million of outside capital, we have provided 677 million of primary capital, that's IPOs or follow-on fundings to small businesses. So we've recycled the outside capital we've raised multiple times. And in the process, the NAV per share is up 25 times. Well, the return is 25 times. And we continue to be evangelists for the tech sector. So the next page just shows the long-term performance. And the dark blue line is our NAV. And below that, the orange line at the bottom is the US technology index, the Russell 2000 technology index, which I think the inferiority complex people have in the UK versus US tech, people may be surprised how dull that's been, and over the long term it hasn't performed any better than the Deutsche Numis smaller companies index. But my competitive streak is irritated by the fact there's a green line that's soared past us just in the past 2 years, and that's in the context of 30 years. And the explanation is, as a lot of you be aware, is the Magnificent Seven, or perhaps the Magnificent Five. It's the Nvidias, the stocks that have been driven by AI in the last couple of years that have really accelerated that return. And on the next slide, this is just a scoreboard that we've made 1.5 billion after expenses. But what may surprise people is that we've actually made nearly 1 billion out of UK stocks or UK listed stocks. So it has been the dominant contributor to profits over the last 30 years. But I have to say, less so in the last 5 years. And I have to say, I don't think it'll be the dominant contributor to profits going forwards, because the UK sector has shrunk and continues to shrink. And I think some people wonder, if we go on to the next slide, some people wonder, why on earth have we done so well in the UK sector that hardly exists anymore? And the simple answer is we've invested early stage. often in loss-making businesses. And we have had a lot of exits by way of takeover. This isn't unique to the UK. You can see in our 4 regions, we've had takeovers everywhere, and nearly as many in the US, although that's been a smaller part of the portfolio. The fundamental difference is that in the UK, of those 68 takeovers, virtually all of them, or nearly all of them, have been taken over by either US corporates or US PE. And overall, of the 152 takeovers in the last few years, 60 have gone to PE. It's the same in the States, that takeovers have been by PE and corporates, but they have largely been domestic buyers. So that has been the challenge. That hasn't been the money. I think it's been the steady withdrawal of the institutional money in the UK has meant that valuations have been lower in the UK. So the consolidators have been largely from the US. But it does mean we've realised 312 million from the UK in the last few years in takeovers alone. What's interesting is that more recently, takeovers have broadened out to Asia and Europe. It was very much the PE was focused on probably the UK first, and then the US, and now they seem to be more interested in Europe and Asia. And 2 of our European portfolios are under the hammer from private equity takeovers. And frustratingly, management are going with them because they feel they can thrive more under private ownership. This shows our geographic allocation. To my surprise, there was a peak point when the UK was 70% of the fund, and that was because there were some stunningly good buys in 2008 and companies that perform really well and takeovers at a premium. But it's now come down to the lowest level it's ever been, and I think as of today it's 36 point something, and America's up at 32%. The next page. This was a table that I put into the accounts for Herald Investment Trust in 2020 to show that we had a very good run, the whole tech sector had a good run sort of over COVID, but and actually the year before COVID. And this is just a way of illustrating cycles in the market. What this is trying to show is that in 2013, the average P of the portfolio was 16.8 times. UK stocks, the average P was 16.9. North America was a bit more expensive at 20.9. Europe a bit cheaper, and Asia a lot cheaper. And we stumbled along at that sort of valuation for some time. But then there was a big re-rating in 2019 and 2020. And the portfolio valuation went up to 30 times. So companies, compared to their profits, were being valued more highly. And again, the US had the biggest bubble, but the UK was re-rated too. And in fact, in percentage terms, the growth in Asia was quite extreme. And then actually, although the assets grew in 21, so did profits. So the P fell a bit. And then there was a sharp sell-off in 22 when the P of the whole portfolio came back to 17.8. And the UK, by a small margin, became the cheapest market. The difference since then is that the other markets have rallied more than the UK. So now the UK is still at the sort of long-term average of 16.5, whereas the other markets are more expensive. The one anomaly, I would say, is that it feels like a surprisingly narrow valuation gap between the UK and North America. The problem I have with North America is that it's become very widespread in the technology sector to compensate employees and management with shares. And these numbers are based on Bloomberg forecasts, analyst forecasts across the market. They're not our forecasts, they're market forecasts. And sometimes it's not uncommon to have management given 5% of the share capital by way of compensation, which doesn't go through an adjusted earnings per share figure. And so that, I would argue, is a colossally understated number. And it's something people should be very wary of, is when there's an adjustment to exclude share-based payments. And it's an accounting figure that's a bit wild anyway. I think the easiest way of working out what the cost is to see how much the share count has grown and think how much would it have cost the company to buy the shares back. But it can make a material difference. But I hope that the tables just show the change in the PE from time to time. But I hope that you hear in the background and people saying how cheap the market is in a loose sort of way. But I just thought you might be interested to see how it's quantified in the context of small companies in the tech and media sector. So the next page. Again, this is sort of dwelling on my frustration of the inferiority complex people have to the UK, and the fact there has been this colossal divergence between the Magnificent Seven and the rest of the sector. Because actually, this is purely statistics based on the stocks in the technology and communication sectors and how they performed in the first 9 months of this year. And I think it may surprise people to know that the worst performing region has actually been North America in the small cap end. But above less than 100 billion, it's 8.2% versus a decline of 12.8% for North America as a whole. And clearly the stocks above a billion have done a lot better, as evidenced by the graph I showed at the beginning. So this small cap wilderness is fairly global. And I think one of the challenges facing small companies is that cash flow is going into index trackers, and index trackers don't invest in small companies. Next slide. This is the AI bubble that's driven the magnificent, or some of the Magnificent Seven. And candidly, the supply chain has helped us a bit, even at the smaller company end. But at the moment, it's not just a bubble, there is a lot of money being invested in the infrastructure and supply chain. So there are real numbers, revenues and profits coming out of that point. The $60 million question is, who's going to profitably use all these tools that are being generated? And it was very much the talking point at the SATS conference in San Francisco, that we're still waiting for people to have material revenues from it. I think already people are beginning to have cost benefits by being able to do things more efficiently internally. But at the moment, it's very much a bit like the internet. There was a lot of money going into the rollout, and then 25 years later, we suddenly see a lot more applications, and I'm sure it will be the same with artificial intelligence. And the next slide. This just highlights that AI has been the talking point this year, but there are a lot of other sectors within. It's not a homogeneous sector, but there are a lot of other parts of the sector that have got growth drivers. On the other hand, there is clearly diversion of resources into AI, and an area that's conspicuously weak is IT services businesses. And I will look at wage inflation data, and there is no wage inflation in IT professionals at the moment, which is quite a turn up for the books, because they were very buoyant when other people weren't having pay rises. But you can tell regulation drives demand for technology solutions. ESG does. Trade wars are causing supply chain changes and big reduction of manufacturing in China or moving to other parts of the world. Security is a non-discretionary part of people's cost base these days, and criminals get ever more creative, so technology has to keep up. And I won't go through them all, but but obviously everybody in defence is smiling at the moment. But as I say, it's not a homogeneous sector, and automotive demand's probably a bit squidgier. Next slide. This is a few macro factors, which are a bit of a hobby horse of mine. There has been an almost terrifying withdrawal of equity from the UK, and initially over a long period of time it was pension funds and insurance companies, but just in the last 18 months there's been an acceleration withdrawal by domestic investors from funds, and I think it was even a 666 million withdrawal from UK-based targeted funds last month, an acceleration sort of in the last couple of months. And one of the problems of this is that the UK small cap scene, the core investors in the last few years have been funds, because the insurance companies and pension funds have gone. So they are the core of the market. So it's unduly hitting the UK. And I think that's why it hasn't undergone the re-rating that other markets have, and why it remains cheaper. But you can see one of the drivers last year was interest rates normalizing. Suddenly people thought, well, do we want to risk all our money in equities when we can get a return from cash? We've then had the headwind of the cost disclosure rules that James was talking about earlier, which has led to very heavy outflows from both funds and the investment trust sector. And then it sort of feels like kicking us when we're down. We then have concerns about capital gains tax on IHT, and I think the more recent acceleration in withdrawals has been led by tax incentives. But I do stress that it's terribly obvious that if there's more money coming in than going out, then there's takeovers, then there's IPOs and new issues and follow-on funding to help existing companies grow. And if money is leaving the market, then you have to have takeovers. So that's why we've had for a long time a for sale sign above UK equities, because money has been leaving the market rather than going into it. The other challenge has been that cash flows have been going into ETFs, and that's the regulators highlighted the fact that active fund management costs more than passive. The economic problem with that, forget about those of us whose job it is. For the wider economy, the challenge is that passive investing does not provide primary capital to help companies grow. And I do draw attention to the fact that the outperformance of the US market has been from young companies that have raised capital in my working life. And my working life is long enough to remember the Microsoft IPO when they raised $58 million as a small company, and they haven't raised any money since. But if you don't have small companies, you won't have the next generation of big companies. And on valuation terms, efficient markets require active management. The third point I want to mention that powers that be change IPO listing rules and so on, but as far as I'm concerned, it's not a shortage of companies in the UK. It's a lack of capital that means the market is shrinking. And in the early days, we put primary capital into Acorn, which had an interesting subsidiary called ARM, and Imagination, which did the GPUs for the mobile phone. I just don't think those companies would have been funded by the market now, which is a pity. But it's not. It's very making it all sound rather gloomy. The advantage is that if there's a shortage of capital, there's good value, and it's the constant tension between shares being the cheapest in the UK. And on the valuation grounds, we probably have all our money in the UK, but we daren't, and we don't fund new businesses. We haven't in the recent past, which is why I don't think we'll make the money in the future. We haven't in the last few years put nearly as much money into early stage companies because we have been fearful that there aren't enough co-investors, and if they need more money, there won't be money around to provide the follow-on capital. And I'm very sad to see how hard some entrepreneurs have been hit by having to dilute themselves at very poor valuations to raise money. So yes, there's value in the UK, but we're also seeing opportunities. We've talked about the decline in small caps in the States. In the States, whereas AIM provided an opportunity for us to invest primary capital to help companies develop, increasingly IPOs in the States have been exit routes for smart venture capitalists. And we found the space of IPOs in 2021 uninterestingly high in terms of valuations. But we have been more interested recently in a lot of what I call broken IPOs. And I think the average return on the IPOs in that bubble period was minus 40% in the US market. And some of the companies have grown usefully since then. So there's now much more interesting value. I think that was the background I wanted to draw attention to, James. Do you have any questions for me, or?
I do. There are some there. Please do keep putting them in. So actually, let's start with it popped up before you said it, but about AI being in a bubble. And that is your stance, is it? That you think it's run up
No,
to?
I'm saying there's very real demand. There is billions.
Hmm.
The size of a country is being spent on building the infrastructure, and it's not just NVIDIA chips. People having to build new data centers, people having to have green energy. So there's demand for renewable energy, and our biggest holding is in that area. Are complaining that demand was constrained by both supply issues. Demand was so strong, but also downstream challenges as well, that people are struggling to get planning permission for new data centers and struggling to get the energy to power new data centers. So it's very real what's being spent. But the next phase is the applications that, if all this money being spent, who's going to make a return on it? And it's obviously the big spenders are the Microsofts and the big data centers. And they are expanding capacity, and the same capacity is constrained. But I think a lot of people are trying it and seeing it, and maybe being a bit more efficient. But longer term, there will be applications that we haven't hitherto had. NVIDIA point out that data centers is only one part of the AI market. There's also driverless vehicles, and that's clearly on the horizon, which is not a data center issue. But there are obvious examples like computers being able to read medical scans, which should lower the cost and enable preventative medicine at reasonable value. But there are all sorts of applications that will emerge now. The technology is there to provide for it, but it will take time to come through. I'm sure in 20 years' time we'll be surprised. There's probably some of us are surprised quite how much the internet has become pervasive and changed our lives. And I think it will be a driver for the sector for the next decade. And as ever, it's often smaller companies that adopt new technologies quicker. But the big CapEx has been provided by the big data centers.
So does it matter if NVIDIA is too expensive, or to your market? Does it matter what's going on with those?
No, it doesn't matter. I mean, it only matters because it irritates me that they've gone up more than we have.
Fair enough. Fair enough. Cool. Okay. If you take a sort of step back a bit, how are you actually finding these companies when you've got a lot of things to sift through? What stands out as a sort of promising thing? How do you identify them?
Well, for a start, there is a lot of availability. In the UK, people walk to our door because we're known to be one of the biggest players in early stage stuff. But interestingly, we're even in New York, even in America, we're labelled as there's a much smaller number of professional investors who target the small cap market. And I actually asked a US broker, talking about sort of sub 200 million market cap companies, how many people can you realistically market to? And they said, well, it's tougher than it used to be. We've probably got 150 names, and people they can look to raise that sort of money from smaller companies. That's probably where we were 10 years ago. And now I'm afraid the list is frighteningly short in the UK. It's not big enough to be a marketplace. You can't have a marketplace if there are only 20 potential players. To have the whole point of the stock market is you have lots of buyers and lots of sellers, and you find an efficient market. And I guess one of people are apprehensive about potential changes to tax rules on AIM, or wanting to take gains. Glad to say some of our investors have got very significant gains. If there's an overhang of worries that gains of the last 30 years could be taxed, there's an incentive for people to realise it. And that doesn't help supply of capital to new businesses. In the UK, the new market, there have been a few placings for follow-on funding, but the IPO market's almost closed, and it's not, to be honest, much more open in the States.
So it does mean
more money is going into index trackers that are getting more and more expensive.
Yeah. I suppose if any company needs to raise money, they're going to knock on your door. Is that?
Yeah, absolutely.
Yeah. And then in terms of Asia, are you investing across the whole of Asia, including the sort of emerging bits, or is it mostly the developed market stuff?
Well, our core market, and the market that's been the most profitable for us, has been Taiwan, because that is really, to the computer industry what black country in the UK used to be to the motor industry. And they are very smart, and they've got Taiwan semiconductor manufacturing company that's become by far the most powerful semiconductor company in the world. Japan is also increasingly on our radar screen, and South Korea is slightly smaller for us, as is Australia, but those are the main markets for us in Asia.
Would you look at China?
We do focus on developed Asia. Well, we look at China, but we've got one of the team was born in China, but it's quite challenging for external shareholders to invest in China. We've had the odd holding via Hong Kong. But there's a lot of
and in America, sorry.
There's a lot of growth in China,
in America.
This is how much it will end up in external shareholders' pockets.
Yeah, okay, that makes sense. That totally makes sense. Sorry. In America, are you at all worried about which way the US election goes, or is that irrelevant?
Yes, I mean, it's constantly a debate. It's not doesn't appear to be a very exciting choice, does it?
Yeah.
And on balance, it surprises me how many of the people I mix with in America are more frightened of Kamala Harris than Trump, because I think he's considered to be a bit more friendly to business. But if he introduces lots of trade wars, that could be another challenge, couldn't it?
Yeah. Okay. Cool.
On the whole, on the whole, it's as I say, it's surprising to me from the UK press. You wouldn't think anybody would ever vote for Trump, and I'm surprised how quite intelligent, grown-up people seem to think when you've got to hold your nose. Anyway.
Cool. As things get taken over, I mean, we talked about how many things be taken over. Sound like here. Are they disappearing into private equity forever, or are they coming back as IPOs again?
Well, that's a conundrum. That opens up another debate, doesn't it? Because private equity ultimately needs an exit. I'm a passionate believer that public markets are work for a long time and are the best ways of funding companies because they provide permanent capital, whereas private equity tends to be temporary capital. And they've all got funds with lives that need exits. And at the smaller end, there are exits going from private equity to private equity. But the bigger ones do need to come back to the public market. But they haven't come back to the UK market. Sweeping generalization. But the conundrum is they've had several years where they haven't been getting the exits they anticipated. So we do need to have a public market. And the worry is if smaller companies aren't getting funded by the public markets, it seems that the vibes you pick up is they're hoping venture capital will replace it. But there isn't a very big venture capital community in the UK, apart from American investors, and they're likely to want to invest in companies globally and are more likely to get exits in America, I would have thought. But it's noticeable that I think the pace of takeovers from PE has slowed because they are more valuation sensitive now. They can no longer benefit from the leverage of very cheap bank debt.
Yeah, that's definitely true. You tend to keep some sort of cash on hand in the portfolio. What's the sort of thinking behind that?
Well, as you can tell, a lot of cash in relation to the size of our fund comes in by way of takeovers, and it comes in lumps from time to time. But there tends to be a progressive outflow of cash into new investments, and in the last 18 months for us, share buybacks. But if we don't have lumps coming in, you know, the cash balance tends to go like that, and then there's a takeover, and then it goes down again. And a week or two ago, I said we've got no more takeovers on the horizon, and now we've had two quite big ones in Europe, so that will probably replenish supplies. But we do participate in follow-on funding, and we always want to be able to support our policies to try and be supportive shareholders and support people when they need more money. And we don't want to have to sell shares to do it, because selling shares in a liquid market can be quite expensive. It is remarkable, the divergence between, if you want to sell more than a ISA amount, to sell a big line, you might have to take a big discount. Whereas when there's a takeover, it's very interesting that premiums in the UK have been 50 to 100% or more, whereas takeovers in the States, the premium is more like 20%. But it shows that the missed sort of valuation in the UK, or the inefficiency of the market in the UK. It's always much easier to buy things than sell.
Exactly. In terms of, is there a crossover between you and the big tech funds at all, or are that you basically in completely different parts of the market?
I think I would think there's almost zero correlation with the big technology trusts. We have our own smaller large cap fund, and that we have some overlap on that. Some of the ones we've run have become larger.
And do you think there's difference in the themes that you're exposed to?
Well, I have to say our best performing stocks have been in the supply chain to the AI space. But on the whole, I would say yes. I mean, you can say that fantastic companies of Amazon Web Services and Microsoft are not in our remit, but then it's not to say they're not relevant to the remit, because it has enabled young companies to establish themselves with much lower capital requirements. 20 or 30 years ago, small companies had to raise a few £1 million to buy a mainframe or a AS400 IBM computer or whatever, and buy a storage array, and now they can just rent it, fantastically inexpensively. But it's another good thing about the sector is that it means there's a lot more recurring revenue. Technology used to be a capital expenditure item only, and when interest rates go up, people reduce their capital expenditure because it costs more. And whereas now so much more of the sector is a revenue cost because people rent data centers, they rent software, the software as a service model, and it's become as necessary as the electricity for businesses. You can't just turn off the systems on which you operate. So there's a very, one of the appeals of the sector is it's got some of the characteristics of utility, but with growth.
Yeah. Within the UK, I mean, obviously, you talked about the selling that's going on now, and whether it's CGT or IHT planning, people sort of panicking what the government might do. Are there things the government could do that would actually positively impact the sector?
Well, I would like there to be more proper professional investors who can co-fund alongside us companies that need capital. And it was fantastic when pension funds had positive cash flows every month, and when they got a bit cautious, they sat on their hands and let the cash build up a bit. And I do scratch my head and think, is it rational that we're exporting capital to competition and to other markets with tax relief? We get tax relief for pension money, we get tax relief for ISAs. Is it rational that the government's subsidizing us to invest in China or other markets when so evidently there's a shortage of capital at home? I don't know whether you could have a franked dividend or something, meaning there's a tax credit if you have dividends that have had corporation tax, which was the sort of effect of advanced corporation tax that was abolished in the late 90s, the end of the last century. And that was obviously one of the drivers to the change of allocations. But it's definitely, people behave, people react to tax. And I believe in free movement of capital, and I absolutely don't think the government should force people to do things. But when they're actually giving people a tax benefit, I think they have more right to do something.
That makes sense. We'll see, but whether we get it in this budget or not, I don't know. There's a couple of questions about Herald's discount. I mean, it's something that maybe you can't comment on, but it just frustrates me that it's the best performing global small cap fund now. I think over short term and long term, and yet the discount is still a perennial thing. What's the sort of thinking on buybacks and stuff?
Well, given the illiquid portfolios we have, we've always been resolute, or the board have always been resolute, that we don't have a target discount.
Mhm.
But we think it's very important to have a closed-end fund when you are investing in early stage stuff with a median market cap of 280 odd million. But equally, we don't want people on the register who don't want to be there. And it is a bit depressing that we have spent nearly as much buying back shares this year as we've raised in outside capital ever. It's probably about 80 million, and we bought back 107 million last year. So last year and this year combined, we've bought back twice the outside capital we've ever raised, which we're slightly shell-shocked about because it's unparalleled. I've never experienced it before in the 30 years of running the fund. And what's also odd is you normally expect to be under pressure when there's a bear market. And it's really odd that it's happening against rising assets, which shows that there's something structural going on. It's not just a cyclical change. Does that make sense?
Yeah, it does. Yeah, definitely.
It's very that we're willing to buy back if we've got the cash to do so. And we've been lucky that we've had some good realizations that's enabled us to buy back. So it's as much our cash position goes into the mix.
And with Herald, has the share register changed much over the years?
Yes. When I started, I was completely unknown in the retail world. It was entirely an institutional investor base, pension funds and insurance companies, a number of whom were clients of mine when I'd been on the sell side at Warburg Securities as it was then. And then there was a change at the sort of turn of the century when pension funds started withdrawing and insurance companies couldn't invest in equities because of solvency rules from Europe. So there was a rotation into wealth managers, and there now seems to be a rotation out to the wealth managers, and there's largely the sellers now.
Which may be the cost disclosure thing that hopefully is rectified, but we'll have to wait and see on that, I suppose.
We're certainly aware that some of the long-term holders have been told they've no longer got any investment trusts on their recommended list. And so it has had a behavioural effect. And it's just very unfortunate that just on top of that, we get the CGT effect. Whereas I've also been told, I'm awfully sorry, Katie, but our clients have rung up saying, they've got a big gain. They want to bank some of it.
Fair enough. And there's always something new going on in the sector. I suppose there's a couple of questions about the team. I know I think is there something right? There are 10 people in the team.
That's right. Yes.
It's a lot of work to do to keep on top of it all. I think there's a couple of questions about how do you manage it.
Well, we split the portfolio into 4. So I'm responsible for the UK portfolio now, and back in 1999 I delegated Asia, and then about 2017 I delegated Europe, and about 3 years ago I delegated North America. But the whole point and benefit of being a global investor is you get the cross-referencing, which is why we're so busy. It's there's a jigsaw and you have to put the pieces together. And so as well as having management responsibility, people have sector responsibilities globally. So one member of the team looks at semiconductors, and another member of the team looks at infrastructure software, and another member of the team looks at the internet companies, and so on. But that cross-referencing is pretty important because a lot of, particularly in technology space, less so in media, that's a bit more parochial. But in the technology sector, on the whole, people have a global customer base. And so the competition is often overseas. So that's why the cross were
That all
we
makes sense.
benefit from.
Yeah,
Mm.
good. I think we've covered a lot
And
of
I
ground.
also think it helps us invest in larger companies
Yeah,
because you do. I mean, it's out of date now, but it was fairly obvious that Apple was. There was a time to buy Apple and not BlackBerry or Nokia,
yeah,
when you could see the suppliers that were supplying Apple were building capacity and profit warnings from the others. So um, uh, it's very helpful to look at the whole jigsaw.
great. Thank you very much indeed for your time this morning. We've got a couple of questions. So we'll get you back on again in a year or so and find out how things are going. But thank you for today, and talk to you again soon.
Thanks very much.
So next week we've got Helen Steers on from Pantheon International, and then the week after Job Curtis from City of London. So we're sort of covering the basis in terms of different sectors, different geographies. Have a good weekend, one and all. If you haven't voted in the awards yet, please do that. We will see you next week.